All right. The topic of today's conversation is using ice cream to sell disability insurance. And I know that's a slightly unique topic for a webinar, maybe a unique title, but I want to tell you why it is that we've chosen to do this. At Dibroker, our job is that we are a disability insurance wholesaler. So we're always trying to find more ways to help insurance producers sell disability insurance. And one of the recurring themes that we hear is that identifying prospects or finding new and interesting ways to approach prospects is difficult. And a lot of producers are always trying new ways to reinvent the wheel and find new and exciting and interesting ways to approach prospects. But there's a old, and by I mean old, I mean back in the 1950s and 1960s when disability insurance was new, there was this approach we call using the ice cream approach, or helping our commercial clients, your corporate clients, avoid the ice cream tax. The ice cream tax is not a real thing. It's our way of explaining a story. We found that as you approach clients and try and sell them stuff, instead of saying, hey, you need to buy some products, you're going to be far more effective if you use a story. So it's important to have a story today to tell. So what we're going to do today is I'm going to be telling you the extended version of a common disability insurance story. It's one that's backed up by some case law and some Ninth District Court cases. I've got a lot more details than maybe you've heard before. And the reason I tell you this story is that you have a compelling idea and concept to remember as you reflect on corporate disability insurance. And hopefully you'll be able to glean just enough details from what I tell you today that you can either realize you need to hear more about the story and read more about it online or get some more details about the story from us. But really you should be able to capture some of the high points of this story that I'm about to tell you, maybe jot down a couple of dates, jot down a couple of details, with the end of being able to approach any consumer that you meet that's got any of your corporate clients and be able to tell them the 22-second version of this story. I'm going to give you the 12-minute to 15-minute version of this story with a lot of extra details. The story that we're going to be talking about today is Edward W. Chisholm. You can see a picture here of Edward W. Chisholm. He was born in 1878. To put things in perspective, that was shortly after the end of the Civil War. This is a long time ago. Edward W. Chisholm was born on the East Coast. He ended up moving with his family, the Chisholm family, out to Nevada following the gold rush. In Nevada where he was living, there was a really large silver rush. There was a lot of silver and gold mining, and Edward W. Chisholm did not want to be a miner. His family had a background raising cows, and he decided instead to do what the family did best, and that was to raise cattle. His brother was the cattle genius, and so the Chisholm brother ended up owning one of the largest herds of cattle west of the Mississippi at this time, in the late 1800s, early 1900s. Edward Chisholm, the guy we're going to be talking about today, realized that they had all of this milk that they were getting from the cows, but back in the day, milk storage was difficult. And right around 1904, something fantastic was invented. That's refrigeration. Up to this point, milk had to be distributed the same day that it was milked. Consumers had to consume it immediately before it went sour. They could turn it to butter, but there wasn't much else that they could do with it. So in 1905, Edward Chisholm got one of the first refrigeration systems west of the Mississippi and started refrigerating the milk. And it also allowed them to refrigerate or store frozen milk. Add a little bit of cream, stir it up, add a little bit of sugar, and you've got ice cream. Now, ice cream to miners was a fantastic treat, and the miners loved it. They ate it up, and it was a huge profitable venture for the Chisholm family. Gave them something they could do with all the milk that came from their cows. So in 1905, they started the Chisholm Ice Cream Company. This is a picture of the water wheel that they used to stir the ice cream and provide energy for their facility. This is on the Truckee River in Nevada. From 1905, when they started their company, to 1948, the Chisholm Company became one of the largest dairy producers on the West Coast. It was humongous, and they went from just selling a little bit of ice cream locally to becoming a large distributor, They managed hundreds of distribution channels. They had trucks. They had dairy products. They had ice cream products. They had milk products and cheese products and butter products. This company ended up being huge, which was great for Edward W. Chisholm. He continued to be a business magnate. He was the guy who made the company grow and run. He was the brains of the operation. His brother continued to raise cows and manage the cattle production and the dairy income from other cattle farmers, but Chisholm was the man until 1948. In 1948, here on the Chisholm estate in Nevada, Edward W. Chisholm began to get ill. I don't know whether it was because he was eating butter pecan ice cream every day or not, but he started to have some heart ailments. So Edward Chisholm from 1948 to 1952 went from working 80 hours a week managing his empire down to working 5 to 10 hours a week. So he was staying at home as much as he could. He was trying to get into the business as much as he could, but he wasn't working full-time. He wasn't even working 30 hours a week from 1948 to 1952. But he continued to draw during this period from 1948 to 1952 the same salary that he had been drawing before he started to have these heart problems. At the time, he was drawing a salary of $24,000 a year. To give you some perspective, inflation between then and now has been about 1,000%. That means his income in today's figures was about $250,000 of income, about $250,000 of annual salary that he was drawing for being the CEO of the company. So from 1948 to 1952, he was drawing this $24,000 salary every year. In addition to that, because he was a business owner, and because business owners are crazy and they do whatever they want to do, he also drew additional loans from the company just whenever he needed extra money. In this case, because he had had this medical problem, he ended up drawing about $50,000 every year in extra income from the company, and he just wrote a little note that said, "Note payable, will pay back company later, Edward W. Chisholm," and put that into the treasurer's office, and that's what he did. And I think a lot of business owners that you guys see tend to do the same thing. They draw their salary, but they'll take extra distributions if they need to. They'll draw extra income from the company, or take loans from the company if they need extra income. And that was great until 1952. In 1952, Edward W. Chisholm's heart ailment got extremely serious. He couldn't even go into the office the 5 to 10 hours he was doing. He was entirely homebound. His doctor had him in bed all day long, and the only interaction he had with the company from 1952 to 1956 was that the board of directors would come into his bedroom, they'd stand around the bed, they'd ask him some questions, they'd get his perspective on his vision of the business moving forward. So they had a couple of board meetings from time to time, but he was putting in about a half hour a week of work, if that. The rest of the time was spent him recuperating. This continued until 1956. Then a few days after Christmas in 1956, Edward Chisholm died of complications from his heart problems and no longer worked for the company. He was dead. His wife, Clara, and his daughter, Alice, retained ownership of the company, and they continued to try and run the company the best they could. So 1957, the company files its taxes, and they had to declare to the IRS some information about the estate because Edward Chisholm had died, and his estate was distributed to his heirs, being both his daughter and his wife. Ownership of the company transitioned. So the IRS came and got involved, but there was a problem beyond just the fact that Edward Chisholm had died and his estate was being divided. They started looking into what had happened before the estate had been divided. And they realized that for 8 years, from 1948 to 1956, the corporation had been paying Edward W. Chisholm a salary, and he had not been a full-time employee of the company. And the IRS said, hey, guess what? We don't think that you're allowed to do that. We think that you are not allowed to pay a salary if you're not a working employee of the company. And they said, you're out of luck. And Chisholm didn't like the fact that they were telling him he was going to have to pay back taxes and have to pay penalties. And so Chisholm decided to take him to court. And he sued the IRS, he sued the commissioner, and it went to court, got all the way to the 9th District Court of Appeals, when the 9th District Court of Appeals ruled in favor of the IRS commissioner and said, sorry, Edward W. Chisholm, the money that you are giving yourself during those 8 years when you were not a full-time employee cannot be considered salary. any money that is paid to a non-employee that doesn't meet the guidelines of what an employee is can't be called salary. We have to call it something else. We're going to call it an ad hoc payment. It is basically a gift from the company to a non-working employee, to a disabled sick employee that the company is giving. Now, because it's not a salary, the corporation could not write off that salary as a taxable expense. What's more, because the salary wasn't regular income, because instead it was a gift or a capital gains, Edward Chisholm on his personal taxes had to apply a different tax bracket for those capital gains than he would had it been just regular salaried income. So this was a problem. So the IRS basically won this court case and got to come back after Chisholm for past taxes that he hadn't paid correctly over those 8 years. They came back after the corporation for past taxes that the corporation had inappropriately deducted over the course of those 8 years. They included extra penalties, they included interest, and of course Chisholm was out the legal fees that they had spent trying to fight the IRS on this. So what are the 3 big mistakes that Chisholm made? What could have saved them all the trouble with the IRS? These are the 3 things that they didn't do that they should have done. And these are the things that were found by the 9th District Court of Appeals that Chisholm hadn't completed appropriately. Number 1, Chisholm didn't have a plan in writing. The IRS requires clear evidence that a plan exists. That means a corporation or a business owner needs to write down a plan of what happens if an employee is no longer an employee. For today's discussion, we're going to talk about what happens if somebody becomes disabled or sick. So an employee is working 40 hours a week, they're an employee. An employee gets cancer and isn't working 30 hours a week, they're no longer an employee and they can't receive employee benefits the way that they normally would. At some point, the employer has to stop providing benefits, both in terms of salary, in terms of medical insurance, in terms of other employee benefits. So you got to write down in writing what the plan is for somebody when they get sick. What are you going to give them? How much are you going to give them? When's it going to start? When's it going to stop? What are all the rules that you as an employer are going to provide? Write it down, and it's got to be in writing. Number 2, your plan has to be in place and written down before an illness occurs. So you can't just wait as an employer until somebody gets sick and then start making up rules and writing them down. You got to write them down. You have to be able to prove that they've been written down before an employee or an owner of a company is disabled. Usually that means the document that it's in place before an illness. It means that an employer has to distribute a copy of the plan to employees or bring up the plan in a employer meeting and jot down in the minutes that they've got a plan, the outline of the plan, or submit a plan as an appendix to the minutes of a corporate meeting. Number 3, the IRS must ensure that employees know about the plan. So if you hadn't already told the employees about the plan, as an employer you are required to have a plan, write it down, put it in place, and then tell the employees about it. This is what the IRS requires. This doesn't factor in the fact that as an employer, it's probably a good idea to tell your employees what the rules are. If you're going to give your employees a year worth of sick pay if they're ever sick, if you're going to continue to give them money once they get disabled, you probably want to tell your employees that you're going to do that because you're a fantastic employer. Conversely, if your employee tells you that they have cancer and that they're not able to work 20 hours a week, or if they're not able to work at all, and you're going to tell them that they have 0 sick pay, they get fired the day they tell you that they're disabled, it's probably a good idea to have that in writing so they can't cry discrimination, and you want to let all your employees know that before this happens. So let the employees know about the plan. So Chisholm hadn't done these 3 things. The IRS was very clear that Chisholm hadn't done these 3 things, and they said, sorry Chisholm, you're out of luck. You didn't have a plan, you didn't have it in place and before the disability, and you didn't let any employees know about it. So what's the simple fix? As people that are listening today, as insurance producers, you deal with corporate clients. And your corporate clients have the same responsibility today that Chisholm had back in 1956, back in 1948 for that matter. Your corporate clients have the responsibility to put a plan in place, to put it in writing, and to distribute it to the employees now. Now, they can take the same approach that Chisholm took, and that is to ignore the problem or to not even know that this is a problem. or they can put a plan in place for free. It doesn't cost an employer any money to set up a plan, what we would call a salary continuation plan or a qualified sick pay plan. Those are just fancy names for the same thing. They're going to write down a plan to say what they're going to do if an employee gets disabled. Now, certainly if the employer wants to hire an attorney to choose some really fancy legal language to outline the plan, if they want to come up with a really complicated carve-out plan that deals with different classes of employees, there might be some cost in the sense that they might be paying a professional to help them come up with that plan. But for the most part, there's no cost to setting up protection for the employer to keep the employer from having to deal with the tax consequences of the IRS, or to have the person receiving benefits from having the tax consequences of inappropriately claiming that income the wrong way on their taxes. What does this plan help you avoid? I'm going back to the Chisholm story. The fees, fines, back taxes, and penalties and legal fees for Chisholm were more than the salary that they were paying Chisholm in the first place. The amount of money they spent was so great that not much longer after Chisholm died, Chisholm ended up being forced to get more income for their company and keep things running, that they sold their ice cream division to Nestle. If you go to the store today, you can't buy a Chisholm ice cream bar because Chisholm doesn't make ice cream. They sold their most profitable division, their ice cream division, to Nestle, and now Nestle is an ice cream juggernaut. So had Chisholm had a plan in place, would they still have had to have sold their ice cream division? Probably not. Would you buy Chisholm ice cream at the store? Probably so. Would the family be more profitable? Probably so, just because they didn't have a free piece of paper, a free plan in writing before this. Chisholm still exists. They are now known as the Coca-Cola Bottling Company of Nevada, and they're around. If you buy Coca-Cola products west of the Mississippi, odds are that they were bottled in Chisholm's facility in Nevada. They're still around. So congratulations, Chisholm, they're there, but they are not who they could have been had they had this simple plan in place. So what is a sick pay plan and what does it need to have in there? You need to know about as much of this as is written on this slide, and it doesn't need to be really detailed. But what it boils down to is an employer that you work with ought to receive the recommendation that they should set up a plan, and it should tell who the plan affects. So in other words, who at the company is going to get what, and when are they going to get it. So for example, you could have a sick pay plan that says all the employees of the company get nothing, and they are fired and lose all pay as soon as they tell me that they're disabled and aren't coming into work. Sorry, the only person that gets sick pay is me, the owner. Congratulations, me. They can do that. There's no ERISA guidelines on a sick pay plan. They can also class out different types of employees. They can say the owner gets 1,000,000 years of sick pay, the managers get 2 years of sick pay, the rank and file employees will get 1 month worth of sick pay, and then they lose employment status and don't get any income after that. So you can base that on an arbitrary amount, on a percentage of salary. I've seen the most complicated sick pay plan I've personally seen is that of Wells Fargo. Wells Fargo has this huge matrix that says depending on how long you've been at the company and what your income is, you read this table and it basically tells you how many months of sick pay you receive on top of state benefits and on top of other benefits they provide. It's just how much. We can't call it salary because salary is not allowed to be paid to a non-employee, but how much sick pay, how much of a check the employer will cut for an employee who's no longer disabled. And it also defines when this starts getting paid. So there probably should be some type of definition that says, hey, if an employee is sick, or if an employee is disabled, or if an employee can't perform the duties of their occupation for more than 7 days, we start giving them sick pay. This type of detail in a sick pay plan follows the guidelines that the Internal Revenue Service set up after Chisholm, which, as you can see on the screen, are Internal Revenue Code Section 105, Internal Revenue Code Section 106, and Section 162. If you're dealing with an attorney and you're dealing with a sick pay scenario, these are the sections of the Internal Revenue Code that apply in the situation. But basically, an employer is going to set up a sick pay plan, and they're going to say who it affects, how much money it's going to give an affected employee or owner, and when it's going to start, and when it's going to stop for that matter. The employer can set up how long they want sick pay to be received and paid out. So let's say that you've recommended that a corporate client you work with set up a sick pay plan. You've given them some guidelines on how to set up that sick pay plan, and then you've said, congratulations. Now I'm going to tell you why you're doing this in the first place. Why are we talking to you guys about this whole thing in the first place? And that is this. When you start to talk to employers about paying out income, in other words, they're going to continue to pay out somebody on the payroll some money if their employee is disabled, or if an owner is disabled, the employer then is faced with a decision. And you're going to say, congratulations, employer, you've set up a sick pay plan. Now you get to decide whether you want to be liable to pay that money should this situation ever occur. In other words, if an employee gets disabled and you promised him 5 years worth of sick pay that's equivalent to a salary, do you really want to pay out 5 years worth of sick pay? Or do you as an employer want to offload that risk to somebody else? I have this slide because I say, do you want to pay out a ton of money or a percentage of that money? What we're getting at is insurance exists to pay out a benefit for an employee who can't do their job. It's called disability insurance. That's why I'm a disability insurance wholesaler, and that's why we're talking about this today. You have the capacity to explain to your employer groups that they need to set up a sick pay plan, and then they can fund that plan with disability insurance if they want. So here are their options. The employer can either pay all that money out of pocket should a risk occur, just like Chisholm did. Chisholm got disabled, and he continued to draw from the profits of the company money equivalent to his salary and distributions from the company, and a business owner can do that. There's probably a limit to how much a company can pay out in extra profits or in sick pay when a worker or an employer isn't doing anything for the company. It weakens the company and it limits the ability for that company to continue to do that over the long run. So it stands to reason that most employers would want to offload that risk to an insurer, especially when they've already put themselves on the hook and said that their qualified sick pay plan requires them to pay themselves 30 years of worth of sick pay if they themselves become disabled. There's an accounting standard called FASB 112. And what FASB 112 is, if your corporation has a bookkeeper, this is a bookkeeping standard that says that any financial responsibility that the company gets itself into, in other words, if they write a sick pay plan and tell the corporation that we've got a sick pay plan and there's the potential liability of us having to pay out several years worth of sick pay for an employee or multiple years worth of sick pay for an employer or an owner of the company, we're on the hook should that happen. We're actually going to do that. We're responsible for paying out that money. So on the books of the company, we've got to reflect that there's a potential expense that might happen. Now, this does not mean that the company needs to reserve that money. In other words, if the owner is going to draw $50,000 of sick pay from a company for 10 years should he become disabled, the company doesn't need to reserve $50,000 times 10 years. They don't need to reserve $500,000 in a special bank account that they can't touch. That is not the case. They do need to account for it on paper, though. In other words, if the profits of the company they're coming in are $500,000 a year, and there's a potential $500,000 expense that could occur when the business goes out to get a loan, they need to tell the bank that there's a potential expense of sick pay. When they go to get refinances, when they're going to sell the business or evaluate their business, that's in there. So if somebody's going to buy the business from an owner and he's got a sick pay plan in place, the new owner will know and will take into account in valuation that there's a sick pay plan in place, and it will devalue their company. So it's a better idea for the company to say, we've got a sick plan in place, but we're not going to pay for the sick pay out of the profits of the company. We've chosen to take a small portion of our profits, allocate them towards insurance premiums, and an insurance carrier will fund our sick pay plan instead of us, the corporation, self-funding a sick pay plan. Your business owners make smart financial decisions. It is a smart financial decision for them to fund a disability insurance plan. And that's why you're talking about this whole thing in the first place. It's very common to recommend a qualified sick pay plan, to encourage an employer to set one up, and then use that as the cause to get the employer to analyze their existing disability plan, or if they don't have one at all, to set up a disability plan that you, the insurance producer, can then sell to them. So you can protect the client can have better funding source for the sick pay plan, and you can make some money in the process. So, what would insurance do in this situation? If you were to buy some disability insurance, again, we're not talking about what kind yet, it would pay the benefit. That means there's no cash drain on the business self-funding a qualified sick pay plan. Insurance premiums can be a deductible expense. Not necessarily always are, but they can be a deductible expense instead of paying out sick pay, which is not a deductible expense. Number 3, and this is a huge one. If your clients have, or your corporate clients have a sick pay plan in place that says that an employee gets certain stuff if they become disabled, but they don't have an insurance company involved in funding that sick pay plan, the corporate client, your CEO who set up the sick pay plan, becomes the claims administrator. He has to determine if the client is disabled. He has to get the medical records and determine whether or not the client is able to perform some or all of the duties of the disabled guy's occupation. He's got to reevaluate that client on a regular basis. Now, no business owner wants to become a claims administrator. No business owner wants to have to look at the definition of disability in their sick pay plan and adjudicate it. No business owner wants to deal with getting sued by a person who feels like they should be on claim and getting sick pay and isn't. So it makes sense, makes really big sense, just to get claims administration from a carrier to buy a disability plan so that the carrier can become the claims administrator and determine whether sick pay plan is getting paid out on or not. And so in your sick pay plan, you just say, you're considered disabled if our long-term disability benefits say you're disabled. End of story. And there's no need to reserve, using that FASB 112 standard, there's no need to reserve income on the balance in the balance sheet of the business if an insurance company is providing that benefit, which can be substantial. So those are the reasons that you're going to tell your client they should fund their sick pay plan with insurance. Now, why Chisholm? So I told you the story about Chisholm, who was born in 1894, really? This guy lived like 100 years ago. He got into a tuffle with the IRS nearly 60 years ago. So why are we telling you this story? Why not tell me a fancy news story about somebody else that's had some problems with the IRS? And the reason is Chisholm was the first time somebody really went after the IRS to have the IRS establish the rules for what sick pay plans had to be, how they had to be established, how they had to be set up, how they had to be documented. And so Chisholm is case law. It is the rules. So in 1971, Ochipinti went after the IRS because he didn't think that Chisholm was clear enough. And in Ochipinti versus the Commissioner versus 1971, the 9th District Court of Appeals upheld Chisholm. In 1984, Larkin versus the Commissioner did the same thing. He said, we had a sick pay plan, even though we didn't write it down, and it was in writing, I promise. He went after the IRS the same way. The 9th District Court of Appeals upheld in Larkin v. Commissioner 1984 that Chisholm law was appropriate. They made some modifications and some clarifications, but nothing has changed since 1956 when Chisholm and the ice cream company, or Chisholm, the ice cream company, and the IRS had their first case law. That's why we keep talking about Chisholm 100 years later. It is the definitive qualified sick pay plan rule. So what kind of DI is there? We're not going to talk a lot about product today because we could lecture about product in and out, but there are basically 4 different kinds of products that could be used to fund a sick pay plan. We have group disability insurance. At Dibroker, we can't wholesale you group disability insurance, so sorry. But it's available. We can counsel you on how it's used. We can counsel you on how it integrates with a sick pay plan. Group disability insurance is usually a policy that's bought by everybody in the company. There's no medical underwriting. There's very little financial underwriting, if any. The plans are one size fit all. They're easy and they're cheap. They work, and most of you, if you're group benefits providers, will already have some kind of group disability plan in place. We'll talk about the drawbacks to group in a second, but it's cheap and it's easy and it's better than nothing. We hope that most of you that have groups are recommending some kind of group disability plan. The second kind of DI you can get is individual DI. That's what we at Dibroker wholesale to you. It's expensive because it costs a lot. And it's hard to underwrite because there's medical underwriting. We got to ask a zillion medical questions. We give exclusions on pre-existing problems. There's financial underwriting. You have to get tax documentation. Individual disability insurance is a pain, but it works, and it's valuable, and it's portable, and it's great coverage, especially if your corporate clients want to set up a sick pay plan that only covers them. Individual disability insurance is going to be your best fit because they can buy individual disability insurance to fund their part of the sick pay plan and don't have to worry about setting up disability benefits for the rest of the employees. Another possibility is multi-life disability insurance. This is individual DI that's sold with an individual product, but if you're setting it up for more than 3 lives, you can usually get less, you can get pricing discounts to lessen the price of the coverage. That ranges anywhere between 10 and 50%, depending on what state you're in, what product you're talking about, which carrier, what type of employees. So the discounts are substantial if you have 3 or more lives. There's still medical underwriting, there's still financial underwriting, but it can make, it can give enough cause to an employer to distribute a plan to their employees, or if there's 3 employers or 3 owners, there's some ways to set up a plan. Again, we can talk to you about that more offline. If you have questions, talk to your Dibroker sales rep. We can help you with multi-life DI for 3 or more employers bound by a similar employer. Employees bound by a similar employer, or 3 or more people working at the same company. The last kind of DI there is guaranteed standard issue disability insurance. This means you get it even if you have health problems. It's individual disability insurance that's owned individually. It can be paid for by an employer, paid for by an employee. They can split the premium, but the difference is there's very limited medical underwriting, very limited financial underwriting, and when I say limited, I mean there's not really any medical questions. As long as an employee is working 30 hours a week, they can get it. So you can avoid a lot of the underwriting hassles of individual insurance, but you got to have at least 5 lives for mandatory coverage and at least 30% participation for voluntary coverage. And there's some variation to those rules. Again, if you have questions about setting up guarantee issue disability insurance, talk to us at Dibroker. We can help you understand if you've got a group where a potential guarantee issue case might lie within your group. But it's available, and it's easy, and it's just like setting up group disability. You just fill out a couple pieces of paper, get a census, and you're done. You don't have to worry about tracking down tax returns and getting medical records, etc. Some of the limitations for those of you that do sell disability insurance, and again, I'm going to cover these in depth, but most group disability insurance is paid for by an employer. The benefits are therefore taxable. So while you might get a benefit giving you 60% of your salary if you're ever disabled, that is taxable. So you might end up with only 42% of your income which is covered. So again, even if you have a group that's putting together a sick pay plan and funding it with group disability insurance, at Dibroker we strongly recommend that you look at supplementing that group disability plan with a small sliver of individual coverage that takes an employee back from the taxed 42% of disability coverage and gives them an extra 10, 15, 20%, getting them up to what they would be taking home after tax on a regular basis. What's more, group disability plans are usually not portable, and if they are portable, they usually have very poor portability provisions. If you have a little sliver of individual coverage, like we're looking at in this slide, you have a little sliver of 10 or 15 or 20% of individual coverage that supplements your group, most individual policies will allow you to expand that small sliver of coverage should you ever lose your group or leave your group, or if your group ever cancels their disability contract. I had a producer last week that sent me a group disability contract, and it provided 100% benefits of income. It was taxable, so it got them down to about 80%. Benefits for lifetime. It was a beautiful disability policy. I don't know how the carrier can afford to pay out claims for lifetime at 80% after-tax benefits. What's going to happen is they're going to have a bunch of claims as the workforce gets older, and eventually the carrier is going to say, you know what, we can't afford this. They're going to cancel the group disability contract, and all those employees that think they've got a great benefit are going to lose their benefit. And if they've got a small individual supplement to their group plan, they'll be able to expand their individual benefit to fit their income. Those who don't, hopefully they're still medically eligible and can get some underwritten coverage, but if they're too old or too sick to get medically underwritten coverage at that point, then they're out of luck. They won't have any disability coverage. Definitions on IDI are better. There's better discrimination that's available on group disability coverage. So there's a lot of reasons to be able to sell something above and beyond a group DI contract. So who cares about this? I've given you this sales concept. Which of your employers should you approach? My recommendation is that you should only approach those employers who have a probability of having an employee or an owner actually gets sick. So I've got this fancy table from you from the 1985 Insurance Commissioner's Disability Table. You can look across this and calculate based on the number of people in a group, 1, 2, 3, 5, or 10, and the average age of the people in the group, what the likelihood is that somebody in the group will get disabled before age 65. So if you have 5 people in a group that you work with, and they're all average age 25, so you got 5 people in your group, and they're average age 25, 95% chance that one of them will get disabled before age 65. That's a pretty good reason for an employer to set up a sick pay plan. If you have a small group, small startup business, you got 2 owners and 1 employee, there's only 3 people in the group, and the average age of 45, the odds of one of them getting disabled before age 65 is 70%. That's still 2/3. If you're not talking about qualified sick pay plans to your employees, or to your employers, to your corporate clients, you're crazy, you're nuts, because the probability that one of those people is going to get disabled is pretty high. And you don't want to be like Chisholm, where your employer, corporate client comes to you and says, hey, what kind of benefit did we set up? Hey, the IRS just asked me about sick pay plans. Do you know anything about that? Should you have been the ones helping me set that up? Because if you didn't do it and you're supposed to have done it, then you're liable. Good thing you have errors and omissions insurance, because it's an error if you don't talk about your clients about this kind of stuff. If you as a producer aren't doing it, who has the responsibility to talk to your business owners about this kind of stuff? Really who? Is there a financial planner? Should it be their group benefits guy? Should their property and casualty guy be bringing up this stuff? The lawyer is certainly not going to do it, and you know the CPA doesn't have any clue how this stuff works. You are the person that's supposed to take care of this. So, is that it? Is that why you got us on this conference call? Yeah, that's really it. I mean, there's a lot of potential for you to come up with a lot of sales by doing things just a little bit different. I don't know if you guys have heard the story of Who Moved My Cheese. All of you as insurance producers have something you do well. It is your cheese. I would recommend that you diversify just enough to talk about this one extra idea to your clients. It's going to drive more sales to you. It's going to diversify what you do. And then, for example, if you're a group benefits provider and you're specializing in medical insurance, let's say, for example, that the federal government decides to set up medical insurance and you're out of the business now. Hopefully, you've spent several years diversifying your portfolio, showing your financial prowess to your clients by talking to them about other stuff like free qualified sick pay plans, and help them put disability plans in place. And you make a bunch of money at it, and you have a better base on which to survive with your income. It's just a good idea. Just do it. So here's a case study. We're going to take about 10 more minutes in our presentation today to talk about a case study. This is a picture of a dental practice. You can see that there are 15 female hygienists and staff members. They're the ones that are cleaning teeth, they're doing x-rays, they're answering the phone, they're filing medical records. On the back left-hand side, you can see the owner of this dental practice. I think he's 56 or 57 in this picture. I can't remember exactly how old he is. He was transitioning out of his practice and realized he wanted to sell his practice. He drew a pretty substantial income every year from the salary he's paying himself, but he knew that to meet his retirement goals, he needed to sell his business to a younger guy. So you see the guy in the middle in the black shirt? That's the guy he hired. About 30 years old, 31, straight out of dental school, didn't have any opportunities, didn't have any income, didn't have any dental background other than finishing medical school. So old dentist hires young dentist, and they realized there was a problem. If old dentist got disabled before he got to retirement, if he got some arthritis and he couldn't hold his dental tools anymore, young dentist wasn't at the point where young dentist had enough money in his bank account to buy out old dentist. So old dentist started to realize there was a problem, and he went to his insurance producer, who hadn't been proactive, and he said, insurance producer, if I get disabled before this young kid gets enough money to buy me out, to buy me out for like $1 million or $2 million, I need this kid to have some insurance that gives him a bunch of money so he can buy me out. This is a problem. So the insurance producer came to me and said, hey, Ben, we need some help. I want Dibroker to tell me what the opportunity is here so that I can provide this product that this client is needing. So we looked at the case, and we said, here's what you need to do. Number one, first and foremost, tell us what you've got in place. So the guy said, well, there's 17 employees, and we've already set up a medical insurance plan and a dental insurance plan. That's what we've got in place. That's what I've done so far. And we said, good job. You've done something well. And they said, once the employer started talking to me about disability insurance, I realized I had forgotten to talk about the group disability, so I just barely set up a group disability plan that's both short-term, that goes from 7 days to 90 days, and then a long-term group disability plan that starts at 90 days and goes out to age 67. It's a beautiful group disability plan. I set it up. Congratulations, me. And we said, great. That's fantastic. You've done a good job so far. Then we said, here's what you need to do. You need to go to this group and ask them if they have a qualified sick pay plan or a salary continuation plan set up. And we want you to have the dentist set up rules for the employees, the 15 employees. We want him to decide how much money he's going to give to these girls. Now, since you've already set up a group disability contract, how about you do something like this? You have the dentist write in his qualified sick pay plan that he'll pay any employee's sick pay for 7 days should they become disabled. He'll pay it out of his pocket. He was paying them salary. They tell him they got sick. They're not showing up for work for 7 days. He's going to give them 7 days of income. After that, he's going to transition his sick pay plan to be funded by a disability contract. The short term is going to kick in at 7 days. It's going to pay out sick pay benefits till day 90. Then the long-term disability plan is going to kick in at day 90. It's going to pay sick pay benefits for the rest of the client's working career up to age 67. But we also need to set up the qualified sick pay provisions for you, the two owners, the two employers. So how about we say, we'll have you continue to pay yourselves what would have been your salary, but we'll call it sick pay. We'll do that for 3 months, for 90 days, if you become disabled, and then we'll set up an individual disability plan to take over your sick pay after that. The producers went out. They set up a sick pay plan with the dentists. The dentist loved it. They notified the employees about what was going on. The employees were tickled pink that should they ever become disabled, they had an income stream for life, starting at day one. It was just beautiful. But the dentist didn't have proper individual disability insurance set up, and they weren't covered by the group disability contract. They did that on purpose, actually. They knew that the group disability contract provisions were poor. They wanted robust, portable disability insurance on an individual basis. So we set up individual disability insurance for the two employers. Both of them were receiving a $300,000 salary every year. That's a pretty big salary. So we were able to get them substantial individual disability benefits that paid them $15,000 of individual disability insurance starting at 90 days and going out to age 67. Now, this made a ton of sense for the old dentist because for him, he needed to meet certain retirement goals. He needed to have his $300,000 of income every year to meet his retirement goals at age 67. And we said, guess what? If you get disabled, we're going to keep giving you $15,000 every month to age 67. You'll meet your retirement goals for the income stream you expected to have. And for the young dentist, heaven forbid you get arthritis or have back problems at age 32 or 33, but you'll have 30 years worth of disability benefits that you'll be able to receive that'll compensate you if you can't earn an income during those 30 years until you retire. The dentist loved it. It met their needs for their qualified sick pay plan. It gave them an income stream for their working life. Good job. We also addressed their needs for buy-sell. Again, remember the oldest dentist was concerned that if he got disabled, the young guy needed a bunch of money to buy him out. So the insurance producer got them some buy-sell life. We only helped with the disability portion, and that was a buy-sell disability policy that said, if you're disabled for a year and you're not able to stay in the practice at the end of that year, we're going to give a lump sum of $1 million to the healthy guy that's still working so that he can buy out the disabled guy. And the old dentist said, congratulations, hallelujah. Now if I get disabled, this young kid's going to have $1 million to buy me out. And just in case the young guy gets disabled, the older dentist gets $1 million to buy out the young guy and can then use that money to bring a new guy into the practice and fast-track him to be able to buy him out. The dentists were tickled pink. This solved the original problem that they brought to the insurance producer in the first place. We also said, this buy-sell policy that we're selling you doesn't kick in for 12 months. You have to be disabled for a whole year before we're going to give you money to be able to buy each other out of the practice. So how about, in the meantime, we give you guys an additional $50,000 to cover your share of the expenses if one of you doctors gets disabled so that you can continue to contribute to the practice and pay all the expenses. This practice had this beautiful building, had 15 fantastic employees, had the really nice dental chairs, had TVs set into the ceiling. I mean, their monthly expenses were about $140,000, $150,000. We were giving them a big chunk of money that they could use to offset the loss in patients that they would have if they lost one of the doctors. That $50,000 got paid out for 12 months, at which point the buy-sell kicked in and that dentist got transitioned out of his ownership. The dentist loved it. They said, look, we had one problem. Now you told us that we have two, and you're solving our two problems. You're solving all our problems with all this coverage that you're selling to us. We said, yeah, we're solving your problems, but we got bad news for you. All this insurance coverage is expensive. You already have your medical and dental in place. You're already paying for that. You already have your group coverage in place. You're already paying for that. We gave you a template for a qualified sick pay plan. That part was free. But we're selling you two huge individual disability insurance policies that replace your income. We're giving you two huge buy-sell DI policies that give you $1 million lump sum to buy each other out, and we're giving you two huge business overhead expense policies that eventually could give you up to $600,000 of coverage each if you each get disabled in the business. This is a lot of insurance coverage. It's going to cost about $32,000 in premium every year. And guess what the dentist said? They said, well, yeah, but it's solving our problems. And the insurance producer was so scared to ask for this huge amount of premium in these doctors, and we said, let's put this in perspective. These guys, these dentists spend $1.8 million a year in expenses. That's payroll, that's loans, that's building rent, that's TVs in the ceiling, that's the cost of all the materials that they use, that's their x-ray machine. They're spending a ton of money every month to make their business successful, and the only reason they're spending that money is to guarantee that they'll have an asset to sell and an income stream for themselves. So why wouldn't they spend a little bit of extra money to guarantee an income stream and guarantee they have an asset to sell and money to sell it with? So we took their annual expenses from $1.8 million, added in the insurance premiums we were going to charge them, and took their expenses to $1.83 million. And we said, hey, do you mind if we increase your expenses a little bit? And they looked at it that way and they said, no, it's a cost of doing business. It solves a problem. Sure, here's a check. I was there in the room when these dentists cut a check, an annual premium check for $32,000, and gave it to the producer. And he said thank you, and we walked out, and the producer said to me, what's my commission level again? And I said, you're going to love this. You know, at Dibroker at least, you know, depending on where your commission schedule falls and the bonuses that we're paying out, the commission check was huge for him. I think for that particular agent it ended up being about $25,000, $23,000. It was large. He was very happy. We sent the check into the carrier and he got his commission check and he loved it. The reason I show you this case is because even if you have a small business, 17 employees, even if you have a small business, 13 employees, you need to be talking to your corporate clients, to your business owners about this kind of stuff. Now you say to me, Ben, you told me this really neat story. You shared with me a case study. I still don't know how to approach my corporate clients. If you would like, we also have available to you a fact finder, which I've just pulled up here on the screen. This fact finder is something that we've got. It's 12 questions that you as a producer can show to your clients or use with your clients to gather some details about where they're at with their corporate planning. So for example, does your corporation, sorry about that, does your corporation have a written sick pay plan? If so, get a copy so we can review it. If not, tell them that they need one. But you got to ask that question. Here's how hard it is. Hey client, do you have a corporate qualified sick pay plan? That's all you got to do. It's one question. If you do that with all your corporate clients this year, I guarantee you'll sell some disability insurance. There's also some other questions on here about whether the group has disability benefits on a group or individual basis, about the ownership structure so we can determine whether there's a buy-sell needs, if there's some business transition strategies they have in place so we can determine buy-sell needs. If they have a buy-sell agreement in place, there may be some really easy opportunities to sell buy-sell life, buy-sell disability, to do some succession planning. We're going to ask if the owners have an operating expenses that they're responsible for, even if they're disabled, so we can help you sell some disability business overhead expense coverage. There's some questions on here about business loans, about key employees. This is a really great fact finder for you to find out where the company is and be able to identify some potential sales that you may have down the road. You don't have to sell them this stuff, but I guarantee that if you'll do this fact finder and then come talk to me and say, hey, I did this fact finder, here's what my company said, I can help you pinpoint where your client has some needs and some gaps in coverage, and you can help them out. That'll be available to you if you want to call up our office, Dibroker, at 1-800-636-2112, or call your sales rep. You can get a copy of this Business DI Fact Finder. Again, the reason we provided this presentation for you today was that we want you to believe in disability insurance and believe that this is an important product for your clients. You should own it on yourself. If you don't own DI on yourself today, call us. We'll help you get a policy set up. It is important. Please make asking about DI habitual. Every single one of your clients, if they're individuals, you should be asking them about DI. If they're corporate clients, you should be asking them about sick pay plans. It is the easiest approach. Again, help your clients avoid the ice cream tax. Use this approach. The reason we have this approach is because it's worked. This approach has worked for dozens and dozens of years, for decades. People have been talking to their corporate clients about the ice cream tax and using it as a transition into disability sales. I hope you've appreciated the presentation today. If you have any questions, please call in. Otherwise, thanks for joining our webinar, and keep an eye out for other emails for future webinars we have about other fantastic topics. Have a great day.